Okay, so when we left off last week, we had talked about the double entry accounting system and debits and credits, and how, every time we make an official journal entry, which is recording a transaction into our journal, that, we need a debit account, we need a credit account, and we need those debits to equal credits. So that's kind of where we left off, and we had practiced some of those. So now we're getting into taking those journal entries and keeping an update of every account balance. Okay, so again, the journal is for every transaction, where we showed, like, if we invested cash in exchange for common stock, we debited cash and credited common stock. Now we're going to talk about posting. So posting is when we take those journal entries and we post them to what we call the general ledger. A general ledger is a listing of every account that we use, like from the chart of accounts, and it keeps a running balance for each account. So kind of think of, like, for cash, for example, it'd be similar to like your banking. You would see every time we debited cash, we're increasing cash, so the cash balance would go up. Every time we credit cash is decreasing and our balance would go down. So we're going to keep the journal, which is a record of each transaction and the debit and credit, or debits and credits. And then we're going to keep a ledger, which again is a running balance of every account that we use, which is important, right? Because we need to know at any given time, how much cash do we have? How much have we paid in different expense accounts? How much common stock do we have? So that's the process of that. Once we go from a journal entry to the ledger, we call that posting. Okay, and they're kind of showing it here in T accounts, which is our unofficial form or format. But we purchased prepaid insurance, which is a prepaid expense, which is an asset. So on December 1st, when we paid a premium of $2,400 for 1 year of prepaid insurance, we debited our asset prepaid insurance and we credited cash. Okay. And again, that's showing that in the T account form, so we see the debit and credit. When we actually put it into the correct, let me move this. When we put that into the correct ledger, we have our original journal entry, okay, which we saw the debit to prepaid insurance and the credit to cash. Now, again, this is kind of out of order, that they're showing us our debit and then our credit. Our ledger is going to list in order, in chart of account order, all of our accounts. So we'll see cash, accounts receivable, prepaid insurance, supplies, everything, okay? So in this case, though, they're just showing the prepaid insurance little ledger account here. So we always start with the date, December 1st. We're going to leave this item field blank in this chapter, so we don't put anything in the item field. We'll talk about this post reference here in just a second. But we increased or debited prepaid insurance with this journal entry. So I'm going to put my debit here, and then there's a balance column. Well, it only has that one entry, so the balance right now is just a $2,400 debit. Okay, that post reference is for main reason is to be able to trace your, well, there's two reasons to do a post reference. We have number one, to be able to trace our transaction, and number two, to just make sure that we actually posted it to the ledger. So in our journal up here, this is journal page 2. Notice on our ledger, which is a separate document, we just put in the number 2, for that came from page 2 of the journal. That journal is going to grow and grow and grow, right? So being able to put the page number there, if we have an error or we want to question that, we know where it came from. Okay, so we can trace it back. Same in our journal, what we put in the post reference on our journal is the account number. Okay, so prepaid insurance is account number 15. So up on our journal in our post reference column, we're putting the number 15. So we do the same thing. So once we posted prepaid insurance, we put in that post reference. And then we also need to post to cash. We credited cash $2,400. So we do the same thing. Here's our cash ledger, which notice it already had an existing debit balance of $5,900 based on a month's worth of transactions we already made. So we put in December 1st. Post reference is still journal page 2. We credited cash $2,400, which we know a credit to cash is decreasing cash. So cash went from a running balance of $5,900 minus $2,400. So cash now has a balance of $3,500. Okay. So when we're recording transactions, we're going to go through and do the journal entry, and then we're going to post to the ledger accounts. Okay. Now, I recommend you doing it right away as you journalize. Do a journal entry, then post to a ledger, just so you have it fresh in your mind and you're less likely to make mistakes. But sometimes people will put, like do several journal entries and then post the whole day's worth to the ledger, and that's fine too. We just want to make sure and keep track. So as you're working through, we'll start the project probably Wednesday in class. When you're working through your project, which you will have lots of journal entries and lots of ledgers, my biggest hint on that is don't do your post reference until you post to the ledger. That way you know what you've posted and what you haven't posted. And we'll go through that together. But that's the important step. Don't just put in those post references. Make sure you're putting in post references as you're actually putting those balances into the ledger accounts. Okay. So again, that top little part, just this journal, the journal is where we, journalize each transaction, the debit and credit accounts. Then down here we have ledger accounts. You're going to have a ledger account for every account that we use in the business. And again, that ledger is going to keep track of your debits and credits, your increases and decreases. Okay. Let's see. I think we're good. I want to get through this. Okay. We talked about accounts receivable, making sure we covered everything. We did most of our transactions already. Okay. So this is small, I know, but I just kind of wanted to show you when we were finished with 2 months worth of journal entries. So the book went through and did November and December journal entries. So that was in our journal. This is a snapshot of what your ledger looks like. Okay. So cash, as you can see, is usually the largest. It's going to have the most debits and credits. So again, the biggest takeaway on your ledger is this is cash account number 11. Every time we have a journal entry affecting cash, we post that to the cash ledger account. So a debit here on the 1st was an increase, 25,000 balance. On the 5th, we credited cash 20,000, so that we subtracted it out since it was decreasing, and then we had a 5,000 balance. So again, every time we debit cash, we add to the balance. Every time we credit cash, we subtract. So when you're doing your ledgers, make sure, notice on cash, it's always a debit balance, always a positive balance. The only time cash would ever go negative is if we had written like a hot check, right? And we had written more money than we had. So you shouldn't see like a credit balance in cash. And you'll kind of notice that like your normal increasing side of an account should be the balance. So all of our assets, accounts receivable, supplies, prepaid insurance, land, office equipment, all have debit balances, okay? Now we can credit them, with each transaction, but the balance is a debit balance. And then you have liabilities, accounts payable, and unearned rent, both have credit balances. Common stock, credit balance. Dividends, debit balance. So their normal increasing side is where their balance should be, okay? And then they show like fees earned, which is our revenue. It has a credit balance. Notice we only credit fees earned. Fees earned is a revenue account, so we shouldn't do anything but credit it. We earn revenue. And then we have our expense accounts, which are all debits, and they're all debit balances. So we journalize each transaction, and then we take those transactions and we post them to our ledger, which gives us a running balance of every account that we use in the business. So those are the two most important parts of our record keeping. Okay, we do that every month. Any questions on that? So we're at the end of the period, whether it's the month or the quarter or the year, whatever time we are that we are ready to prepare like financial statements. Usually it's at least monthly. Depends on the business though.
So it's always monthly?
Usually monthly, but definitely we have to prepare them yearly.
Right.
But usually monthly and then quarterly and then yearly. Yeah. So now we're at the end of the period, and the first thing we're going to do is prepare what we call a trial balance. All a trial balance is for our own records. It's not like an official financial statement or anything. We just list every account from our chart of accounts and their ending balance from the ledger. Well, that's really easy to do now because you've done all that work. You've done all the journalizing and posting to the ledgers. So a trial balance is one of the easier things to prepare. And it looks like this. So for Net Solutions, we have our header, which is always the company name, and then the statement name, which in this case is what we call an unadjusted trial balance. We're going to learn about adjusting entries next chapter, so don't worry about knowing what unadjusted means. Just know right now that's what we're preparing, an unadjusted trial balance. And then we put the date. Just like on the balance sheet, we just put the date we prepared it. Okay. So this one is at December 31st, at the end of the year. So step one, we put in our header. Step two, we list all of our accounts. Okay. As you can see, these are in chart of account order. So I just list them straight from my ledger, actually. I'm just going to put cash. And then again, I'm going to put their account numbers in and their ending balances. Okay. One big thing I see on trial balances is, again, when you've done the ledger correctly, all of your assets should have ending debit balances. You shouldn't have a debit and a credit. You should have a debit or a credit. So all of our assets have ending debit balances. And then our two liabilities have ending credit balances, common stock credit, dividends debit, fees earned revenue credit, and then all of our expenses have debit balances. So step three is putting in all of those account balances. And then step four, we add up our total debits, and we add up our total credits, and hopefully total debits equal total credits. Okay. So trial balance is just a checkpoint to make sure that hopefully it means we've entered everything in correctly. If we get total debits equal total credits, then at least we're bound, we've entered in the correct debits and credits. Now, that doesn't mean that there's not an error, okay? I could have posted something to the wrong account, right? Like I could have posted to accounts receivable instead of cash, and we're both debits, so my total debits could equal my total credits. But it's a good starting place to make sure, right? It's at least that my debits equal my credit. So I entered, debit and credit for each transaction, and I posted everything. So while a trial balance does not ensure that everything is correct that I did, I at least have some type of assurance that debits equal credits. Okay. If they didn't equal, I would go back and look at the balance difference and say, well, what if it was off, like, say one was higher than the other by double a transaction. Say we had a transaction like $900, and one of these was like $1,800 higher than the other. I probably just accidentally debited instead of credited. Okay, so when your error amount is like double the transaction amount of some transaction, you probably accidentally debited instead of credited, or vice versa. So there's some things you can look at. Or if you're off, just a transaction amount, you might have accidentally forgot to record a debit or a credit. So there's some common little errors that you can find by doing this trial balance. Okay. So far we've learned how to analyze transactions, and then we took it one step further and we learned to journalize. So we journalized every transaction. We posted those transactions to the ledger and kept ledger for each account, so we had a running total. And then we prepare this unadjusted trial balance. Okay. It talks about errors. We're not going to read through that too much. I think that's pretty much it. Yeah. So once we get to this point, we have all of our accounts and all their balances. If we were to do statements, these were the statement balances we could use. So you don't have to worry about those other charts and everything. That's the good news, is we've kept these accounts up to date. So it's pretty easy to prepare financial statements from this because we have all of our balances. We could use this trial balance and just go ahead and, you know, revenues minus expenses on our income statement and move right along. Okay, so that's not too bad. Any questions on trial balance? Okay, well, let's go back into our chapter 2 practice. So log into Canvas and go back into your chapter 2 practice. In last class period, we worked on doing basic journal entries. Now we are ready to look at journalizing and posting. So it loads here. So we're on number 2. Okay, number 2. And this is just kind of practicing in not a real journal and ledger, but giving us some drop-down menus to kind of look at what it means to post. So to do a journal entry and then post to ledgers. Just
I already did all this.
okay, we can just follow along.
Oh, okay. Yeah, I was like, I already submitted it to you.
Okay.
Sorry.
It's okay.
I was like, oops.
So on October 3rd, 2018, Regal Company purchased $3,600 of supplies on account. Okay, so the first thing we're going to do is journalize that entry, and then we're going to show how it's posted into those ledger accounts. So what would I debit and credit? Well, here, let's go back through. You know, we had our accounting equation, right? Let's put that back up here. We know assets. Assets increase on the debit side. Liabilities increase on the credit side. Overall, stockholders' equity increases on the credit side. With both revenues and common stock increasing and dividends and expenses decreasing. Okay, so there's our expanded accounting equation with all the debits and credits, increases and decreases. So we purchased $3,600 of supplies on account. What 2 accounts are being affected?
Supplies and account payable.
Very good. Supplies and accounts payable. Well, what kind of account is supplies?
Supplies and
Asset. Very good. Is it increasing or decreasing?
Increasing.
Increasing. Good. So do I debit or credit supplies?
Debit.
Debit. Perfect. So on my account title, I'm going to put supplies. I'm going to skip the post reference for now, but my debit is the 3,600. Somehow I had 2,400 in my head. And then accounts payable is what type of account?
Debt.
It's a debt, yeah, so it's a liability. So we know to increase that, it has to be a credit, right? Because we already have our debit too. The accounts payable is credited 3,600. Okay, so this is page 91 of the journal, and we have our date. We put our debit first and then our credit. So that's our official journal entry. And then on the next part, it wants us to set up our accounts supplies, our ledger for supplies. And we're going to take the supplies 3,600 debit and post it to the ledger supplies account. Okay. So the first thing it says enter a debit balance of $770 as of October 1st. So I'm going to put a check mark here. And over in the balance debit, so over here on the right-hand side in the balance debit, I'm going to put 770. Okay, so we have an existing balance in there. And then on October 3rd, we debited supplies 3,600. So on October 3rd, I put in a debit of 3,600. What's my new balance for supplies?
Calculator.
How much? 4,370? Perfect. Yeah, we add, right? We take our existing debit balance plus we debited it, so we increased it more. So very good. It's 4,370. 4,370. Okay. For our post reference, on our ledger, we put the journal page this came from. Well, this came from page 91. So I'm just going to put a 91. Going to put a 91 here. And then this is supplies account number 15. So up in my journal entry, I'll put 15 to show I posted it to the supplies ledger account 15. And then I'd want to do the same for accounts payable. So I'm going to scroll down.
21.
So on accounts payable, it says we have a beginning balance of 26,200. Oops, sorry, I'm putting that in the wrong place already. That's a credit, 26,200. It's on the right-hand side. So October 1 balance, 26,200. And then on the 3rd, we credited it 3,600. 3,600. So since we have a credit and then another credit, we would add again and get 29,800. 29,800. Again, I put my journal page 91 as my reference there. And then I would want to scroll up to my original journal entry and put account number 21 as my post reference. So again, it's just showing a little snapshot, you know, of like a journal entry in the ledger posting. Obviously, it gets more complicated than this. You know, you would have the whole ledger to look through to find these accounts, but that's kind of the basic understanding. Yes.
So why is it on October 3rd, the preference for on the general literature is 91, but up top is 15 and 21? Because that's where I messed up, because I missed those. That's because I put 15.
Well,
So
this is my journal.
Okay.
So it's technically like if I were doing it by hand, it would be a whole separate document than my
In my
ledger.
ledger. Okay.
So what you're doing is creating a cross-reference between the
From
two.
that page.
Mm-hmm.
Okay. That's
So,
why
yeah.
that's why I kept messing up. I was like, why is it not 15? It's 15 up top.
Right.
So that's
Yeah.
what I was like. I was getting
Yeah.
frustrated. Okay. Thank you.
Yeah, they
I was like,
have to be different. That way we're creating that reference between the two. So if I'm in my journal, I can see what account I posted it to. And then if I'm in my ledger,
Thank
I
you,
know what
because I
page
was so
to go to.
confused on that. I was like, why is this not working?
Any other questions on that? Okay. So if you scroll down, it says, do the rules of debit and credit apply to all companies?
Yes.
Yes. It does not matter if we're publicly, private, sole proprietor. It doesn't matter. Rules in debit and credit apply. Okay, let's go to the next one here. The next one, we are looking at more transactions. In this one, we're going to use T accounts to keep it a little more simple than doing the ledger accounts, but your same principles. The ledger is really just official T accounts. You know, you don't see them in the same little format, but it's the same idea. So this one, again, is just kind of reinforcing or practicing journalizing transactions, okay? So we'll take them one by one, and as we journalize, we'll then post to the T accounts, which are down here, just so you can kind of see how things are changing, okay? On number one, we build customers for fees earned. Well, what accounts are being affected if we build customers for fees earned?
accounts receivable and cash,
People, the fees earned.
fees earned.
Yeah, accounts receivable, and in this case, fees earned. So this is when we invoice customers. So they're not paying us today, so we're going to put that in accounts receivable. But we did perform services, so we're going to, deal with fees
Fees
earned.
earned.
So which one do I debit? Accounts receivable. Very good. Accounts receivable is an asset, and it's increasing. The money owed to us is going up. Okay, so accounts receivable will increase or debit 54,100. And then we already said fees earned, which makes sense. Fees earned is our revenue, and our revenue is going up. So we're going to credit the fees earned account. Make that a little bigger. There we go. Okay. So we debit accounts receivable and credit fees earned. So once we've done the journalizing, that's when we then post to our ledger. Well, in this case, we're using little T accounts. So if you scroll down,
Fees earned.
yeah, I don't know why they have accounts receivable on the bottom. But yeah, we credited fees earned. So I'm going to put a number 1 in the 54,100 on the credit side. And then for accounts receivable, that was a debit. So I'll put my number 1 for transaction number 1 in the 54,100. Okay. So here I'm just posting to T accounts. Let's see, number 2, we purchase supplies on account. What 2 accounts are being affected there?
Supplies and accounts payable.
Very good, supplies and accounts payable. Well, supplies is what type of account?
Yeah, asset.
Asset, good. Is it increasing?
Yes.
So we know we debit supplies.
And credit accounts payable.
Perfect. So we debit supplies and credit accounts payable for 1,250. Okay, so accounts payable is when we owe, and we show that with a credit to the liability account, accounts payable. Okay. And then we just do the same thing. We scroll down and put those in the T accounts. Well, we have accounts payable. So I'm going to put a 2 on the credit side, 1,250.
And then supplies.
Yep, supplies is going to be on our debit side.
Yep.
Perfect. So supplies will have the number 2 on the debit side and 1,250.
Yeah, they kind of looked at me funny in the library the other day when I got this right. I was like, yes.
That's
Proud and everything.
funny.
I was proud of myself.
It should be. Okay, number 3, received cash from customers on account. So
Cash and accounts receivable.
very good. Yeah, that one's a little tricky, right? Because it says receive cash from customers on account. So this links back to number 1. When we bill them, now they're paying towards their bill. Obviously not all of them are paying, but a portion of them are paying. So cash, is cash debited or credited?
Credit. No, debit.
Debit, right? Because we received cash. So cash increased. So cash is debited. Very good. The 43,800. And then we're crediting accounts receivable 43,800 because our customers are paying us what they owe us or some of what they owe us. So it's decreasing or crediting accounts receivable. And then we just want to put that into our little T accounts. So cash got a 3 on the debit side, 43,800. 43,800. And then I go down to accounts receivable, and this is on the credit, 43,800. Okay. And then last but not least, we have number 4. We paid creditors on account $600. So what's being affected there? What 2 accounts?
Accounts payable and cash.
Accounts payable and cash. Very good. Is cash increasing or decreasing?
Decreasing.
Decreasing.
Decreasing, right? Because we paid. Very good. So it's going to be a credit. So we know it'll credit cash. So we're going to debit accounts payable. Okay, so accounts payable is debited and cash is credited because we're paying towards what we owed. So we're decreasing our liability, accounts payable. And we're decreasing cash. So we're debiting accounts payable and crediting cash. And we'll see that in the T accounts. Cash is now on number 4 on the credit side, 600. So if I were to balance this T account, I would take my debit of 43,800 minus that 600 credit to get my total in cash right now. And then accounts payable, I debited 600. So same there. If I were to balance that, I would take 1,250 minus 600, and I would still owe 650 to accounts payable. Okay. So T accounts are just an unofficial way of keeping track. You know, it's not a full official ledger. That's the same information in there. And then let's see, the very bottom, it has a question for us. It says, assume that the unadjusted trial balance on March 31st shows a credit balance for accounts receivable. Okay. So does this credit balance mean an error has occurred?
No.
No.
What could have happened to get a credit balance?
Oh, darn it. You put it in the wrong spot. When it's you credit instead of debited.
The wrong column.
Well, that would have been an error, right?
Yeah.
Oh, yeah. that one.
So how could I end up with a credit balance in accounts receivable and it not be an error on my part?
This was in the questions on the other one.
So if it's on there on my part, who could have made an error? What is accounts receivable?
Over our billing.
Yeah, we're billing customers,
Yeah.
right? So how do we, what happens when we credit accounts receivable? Why would we credit accounts receivable? Like when do we credit?
When
It's
someone
It
pays,
makes a payment, right?
Yeah.
So if our credit balance was, if we ended up with a credit balance in accounts receivable,
they didn't pay the full amount.
or they paid
Too much.
too much.
Yeah, they paid
Yeah.
too much.
So, you know, right now we had it that 54,100 was due, and all total they paid us like 43,800. So there's still money owed to us,
Yeah.
right?
But
Well,
the
what if
opposite-
that credit over there would have been like 60,000?
They overpaid.
They overpaid. Okay. Which isn't very common, right?
No.
But it could happen,
I'm
you
sure
know.
underpaid would be the most typical.
Yes, yeah, underpaid. We usually have money owed to us. Every once in a while it does happen. Like I think about, I've had it happen, right? Like if you go to pay a credit card statement and you know they haven't taken into
I've done that
consideration
before.
that you've already made a payment or there's some other
And I got
credit.
credit back whenever I did it.
Yeah, and they give you they send you a check and you're like,
I
woohoo.
had a negative balance in my card, and it just said, you know, I had $100 and something dollars. I guess I paid twice.
Right, yeah, I mean it
I got to spend
happens.
$100 of my own money.
I did that one time. Like I forgot I had like an auto payment set up on a credit
Mhm.
card and I paid it off. So yeah, I had like an extra $50 or $100 on it.
Well, I paid it, ended up spending money, and I paid it again, thinking that
So you hadn't
the
paid it,
entire amount of the
yeah.
previous amount. I was like, wait a second.
It happens, right? So yeah, it could be an error. It's not saying it doesn't mean it's an error. It could totally be an error. But it could also be accurate on our end and that a customer overpaid us. So it's not always indicative of an error. And same with accounts payable. Accounts payable has a normal credit balance, but if we overpaid, it could have a debit balance, which in that case it would be our error. But yeah, just making us think a little bit about how that works. Okay, go down back. Okay, so this next one's this one's actually doing reverse entries.
This is kind of fun.
Yeah, we're like recreating what happened. So in this case, it says Napa Tours is a travel agency, and it's showing us 9 transactions recorded in the T accounts, but it doesn't give us the journal entries. So in this case, we're just like going through and kind of figuring out, well, what happened based on these T accounts. So they're numbered, so it's actually pretty easy to go through,
Yeah.
but it's just kind of,
Which order?
yeah. So we're gonna go in order from 1 to 9 and recreate the journal entries that happened before these T accounts, okay? So if someone handed you a bunch of T accounts and you had to journalize it, this is what you do. So again, it's pretty easy. You know, I look for the number 1 first. So I have a debit to cash. Well, what got credited?
Common stock.
Common stock. Good. So there, I'm truly just looking for my debit and credit. So I debited cash and then credited common stock, 50,000. So kind of easy, but just showing you a different way, a different approach or looking at it. So again, the biggest thing when we're doing these 9 journal entries is always list our debit account first. Okay, debit, then credit. Number 2, well, I see a supplies debit of 3,400
Cash.
and we have a cash credit. So we obviously purchased supplies for cash, 3,400. So supplies was debited and cash was credited. Okay, supplies debited, cash credited, 3,400. And then I look for my number 3, equipment. Equipment was debited 1,500 or 15,000, sorry. Bless you. Do I have another 15,000 credit?
Accounts payable and cash.
Yep, it's a compound entry, isn't it? So notice this one, make sure, remember your rules of debit and credit. Not only do we list debits before credits, debits need to equal credits, okay? So here we have a debit of 15,000 and we see accounts payable 10,000, but then we also have to find the other 5,000, which is cash. So what happened there? Well, obviously I'm debiting equipment, which means what did I do to equipment? Did I buy or sell equipment?
That's why this one went, okay. I kept trying to credit equipment. I was like, why isn't it, what?
Yeah,
No.
it'll be a debit to equipment.
And accounts payable second and then cash.
So if I debit equipment 15,000, what does that mean? What happened with equipment? Did I buy or sell
I
equipment?
bought it.
You
bought
bought
it.
equipment. Okay. So I bought equipment.
But you only spent 2,000 for it.
Did I?
Or did you pay the 5,000 and it still owed
You
10,000?
put 5,000 down, you
Yes,
got a loan for
okay,
10.
you still owe the 10,000, okay.
Yeah.
Yeah, there you go. So I bought equipment that was worth $15,000. I put $5,000 cash down and I put the rest on a note or, you know, accounts payable. So accounts payable, I owe 10,000 and cash credited 5,000. So I paid 5,000 towards this equipment and then I financed the rest, right? I owe it later. So that's a pretty common compound entry. You know, a lot of times we'll put some kind of down payment.
On a car.
Yeah,
Yeah,
yeah, especially something that's high dollar,
Yeah.
not supplies.
Wouldn't a vehicle be considered equipment though?
Yes,
Yeah.
so a lot of times we would just call it like vehicle though, yeah.
When you list it like that, does it always need to go in descending order as far as like accounts payable and cash, so the bigger one goes on top?
Yeah, good question. They'll prompt you to do that. If you listed them the other way, it would
Yeah.
still be accurate,
Okay.
but the book will prompt, or the text will prompt you to put them in biggest to
Biggest to
smallest.
smallest.
Yeah, very good. So yeah, when you're doing journal entries, if you have 2 debits or 2 credits, always put the larger amount first.
Okay.
It's easier to subtract.
Yeah, but technically it's accurate either way, as long as your debit is listed and then your credit.
That's cool.
Yeah. Okay, so that one they threw a little curveball at us. Number 4, well, I see I have a debit to operating expenses
And cash.
and cash credit. So that one matches up, right? So I bought some kind of I had some kind of operating expenses. They didn't tell me what. But a debit to operating expenses, $48.50. Whoops, forgot my form. $48.50. Cash credit, $48.50. Okay. Number 5, well, I see my debit is accounts receivable. And then here's my credit to service revenue. So debit accounts receivable, credit service revenue. So what happened in that transaction? What
What is service revenue? That's what.
service revenue is just a revenue account, like fees earned.
Okay.
So if I debited accounts receivable and credited service revenue, what did I do?
You got money for something that somebody owed you. Correct? No?
Well, I'm billing them.
Okay.
So yeah, I'm making them owe. So, but I actually perform some service, right?
Service for
Yeah.
you. Okay.
So I earned revenue, right? I performed service and I billed my client
Okay.
or clients. So accounts receivable debit, service revenue credit. Okay, so kind of as you're going through these, you can kind of think about, well, what happened? Why, why are we doing this? Number 6, let's see, I see accounts payable 2,500 debit, and then I see the credit to cash. Okay. So accounts payable was debited and cash was credited, 2,500. Well, if I'm debiting accounts payable and crediting cash, what am I doing?
You're paying off bills.
Yeah, you're paying off a debt, right? Probably towards
That
the equipment.
Yep.
So we're making a payment. So we debit or decrease accounts payable and credit or decrease cash. Very good. Okay, number 7. We see a credit to accounts payable and a debit to cash. So a debit to cash and a credit to accounts receivable. So what's happening there?
You got paid for a service.
For your service.
Well, we got paid for what was already owed to
somebody.
us. Yeah, what somebody owed
To
us.
us.
Yeah, good. Now we remember that's where it gets a little tricky.
It's 8,700.
Oh, thank you. I'm transposing, right?
A little backwards.
It happens. Just trying to remember it. Thank you. So we recognize the revenue here. We build them and recognize the revenue here. So on part 7, they're paying us towards what they already owe us. So we've billed them previously and now they're paying their bill. So cash is debited or received and accounts receivable is decreased. Okay, very good. Number 8. Oh, I see a debit to 1,100 operating expenses
Supplies.
and supplies is credited 1,100. Okay. So a debit to operating expenses and a credit to supplies, 1,100. So what is that for? That one's a little tricky.
You've used your supplies up.
Yeah, very good. They put it all under operating expenses, but think of that as like supplies expense. They just didn't separate it out. But yeah, that's exactly it. We used up some of the supplies for this month or this period. So that's what happens when we debit operating expenses and credit supplies. Very good. And then number 9.
Dividends and cash.
Very good. We have a debit to dividends and a credit to cash. Well, that one's pretty straightforward, right?
You pay dividends.
You paid dividends. Very good. So we paid dividends of $1,000. Paid dividends of $1,000. Okay. Any questions on any of those? So it's obviously easy to trace them back.
In the actual homework, they'll be numbered as well, right?
Yes.
That's going to be a pain if they're not numbers.
Yeah, they will be numbered. It'd be really hard to trace them. I mean, you could.
Because it'd just be the same, the
Matching.
numerical value would be matching, so
Yeah,
you'd have to search a little for
you would, especially if there was like a compound entry.
yeah.
Yeah. But yeah, they'll be numbered. That one's really just kind of looking at it in a different way too. You won't be doing that on the test or anything. It's just a good way to look at it in a different light. Okay. Our very last one, and again, we're working with T accounts just to make it easier on the practice, but we'll be doing ledger on the homework and on our project. So it'll help kind of solidify that. But the T accounts just make it easier to visualize quickly. This last one, we're just doing a trial balance. Okay, so next we're same example, if you notice, same balances. We're just taking those 9 transactions during April and we have them in the T accounts and we want to take this T account and put it into a trial balance.
That unadjusted trial balance.
An unadjusted trial balance, yes, an
That's what I
unadjusted
got
trial balance.
confused.
So again, right now, that's the only trial balance we'll do in this chapter. So when you see, it'll just always be an unadjusted trial balance. I don't know why they throw those words out when we don't talk about it yet, but that's okay. We'll do adjusted trial balances in chapter 3. So when I'm looking at doing a trial balance, again, a trial balance is a list of all my accounts and their ending balances. Do I have ending balances right now?
No,
No. But can I calculate them?
yes.
I sure can. So with the T account, again, that's in a ledger. When you're doing a ledger, you're going to keep a running balance, right? Every time we increase cash, we're showing it. Anytime we decrease. T account, though, I need to balance it. So how would I calculate how much I have in cash?
You add the left side minus the right side.
Very good. I'm
Add
going
the
to take
credit-
my
add
total
the
left.
debit and minus the credit.
You got it.
Profit.
Yeah. So you're going to add the left or debit side,
No.
and we're going to add up the right or credit side, and we're going to take debits minus credits, or left minus right.
And subtract.
So basically 58,700 minus all those expenses. And you should get an ending cash balance.
Doing this, you need like the goggles that protect your eyes from the UVs.
Right?
You
The
stare
blue
at
light
forever.
filters.
Oh man, I got the wrong. Oh, I times it.
Oh no, yeah, that'll get
43
you.
million is not the right answer.
No, that would be really wrong.
4195, 950?
Yes, 41,950. So again, we just added up the left, the debits, subtracted out all the credits. And cash, I'm going to list it first, has an ending debit balance of 41,950. Sorry, do what?
I got it.
Okay. So yeah.
You do this on every single one.
Mhm.
Doesn't matter in the order that they go in.
Yes. So we are going to go in chart of account order, which in this case, I'll just show you. They actually listed them. It's like cash. They listed them down, like
Oh,
cash,
okay.
accounts receivable, supplies.
So it's like liquid to not.
Uh-huh. Yeah. So all of our assets first, but they actually listed them in order. They just went down column, so cash, then accounts receivable, then supplies. So yeah, when we're doing our unadjusted trial balance, we just go, they'll usually give you a chart of accounts and you would just list it in that order or the order that they're in the ledger, same difference. So our next one's accounts receivable.
9,500?
9,500, good. And again, we only have two there, so that makes it easy. Debit minus credit. Again, it's an asset, so it should have an ending debit balance, and it does. My debits are greater than my credits by 9,500. Okay. My next one is supplies.
23.
2,300, good. We had a debit of 3,400 minus 1,100 credit. So supplies has a debit balance of 2,300. And then our next one, I go up to the second column, I have equipment. Well, it only has a debit, right?
Mhm.
So that's the balance. So equipment has a debit balance of 15,000. Okay. Let's see, after that, we have accounts payable.
Credit balance is 7,500.
Very good.
Yes.
Accounts payable increases on the credit side, and the credit is greater than the debit. Okay, so 10,000 minus 2,500, 7,500 credit. So accounts payable, 7,500 credit. So the balance should always be on the bigger number side. Okay, and again, I know I repeat myself, but that's how we learn, right? The balance should be on the normal increasing side. So all of our assets had ending debit balances because debits increase on the debit side. Liabilities have normal credit balances. So we saw an increase on the credit. Common stock only has a credit balance, so that one's nice and easy. Common stock, 50,000 credit. Common stock, 50,000 credit. Then we scroll up to the third column. Dividends just has a debit of 1,000, so that's its balance. Dividends, debit 1,000. Debit 1,000. Then we have service revenue, our revenue account, 18,200 credit. Service revenue, 18,200 credit. Some of these are nice and easy, right? And then last but not least, we have operating expenses, which has two debits. So what would we do to get the balance there?
Add together.
You just add them together. Good. So we add up our total debits, what, 5,950?
950.
5,950 to operating expense debit. Okay. So again, when you're doing the trial balance, just make sure you put it in the correct column, double check that. Go back to your sheet, and look and make sure you're putting the right debit or credit in. And then our last step is we just add up our total debits.
75,700.
She got it.
You guys got it. 75,700. What about credits?
Same thing.
Perfect. 75,700. So just a single underline means we're going to do some type of addition or subtraction. So we added all those up. And then they go ahead and give you the double underline, but we would technically do that when those were balanced. That's like the accountant's way of showing, hey, this is correct. So we double underline because those equal. Okay. So then our last little question, now this is a throwback to last chapter, see if you remember. It says, based upon the unadjusted trial balance, determine the net income or net
You
loss.
have to do an income statement.
You would do an income statement, but what do you do on an income statement?
Assets minus liabilities.
Ah, that's more of your balance sheet.
Oh, wait,
What goes on your income statement? What two accounts?
cash minus liabilities? No, shoot,
It's your
cash
fee-
something.
It's your fees earned minus your expenses.
Revenues minus expenses, yeah. I'm like, let's just keep cycling through there. No, just You're like, you got it somewhere, right? It's like, it's there somewhere.
So it's a net income.
So yeah, that one's a little bit, it's a little bit of a review. So revenues minus expenses. Okay, so in this case, we just have the one revenue and the one expense.
Oh.
Oh,
So you're just taking service revenue minus operating expenses to get your net income in this case.
And look, that's shown me for a while, you guys too. And the only reason that it started to click in is because it asked for that month. It's not asking like an overall valuation of the company.
Right.
It was asking for that
4,250?
specific month.
12,250.
So
got
it
it.
lets you know that everything, the only thing you needed to look at was, did you make any money that month? So
Yeah.
what did you
Yeah.
have in revenue
Yeah.
and then minus your expenses?
okay.
Very good. Yeah, just this month.
So it would be a net income instead of a net loss.
Yes, and that's because your revenue is greater than your expenses. Yeah.
Okay.
So yeah, that one's a tricky one, right? It's just like reiterating, and we're looking at it in a different light. So we're not looking at it as a statement. So it's like, oh wait, what is that? But good. So yeah, revenues minus expenses. In this case, we just had service revenue minus operating expenses. But that's kind of the glorious thing about when you have a trial balance. You can take that trial balance and prepare that income statement because you have your revenues, you have your expenses. Even if we had more than one revenue and more than one expense, it's still easy to calculate. It's always just total revenue minus total expenses. Okay, so a net income of $12,250 for this month.
The revenue always gets me because I feel like I should add cash to it,
Right?
not just the revenue.
Yeah, it does get tricky at first. So just always think your cash though isn't just, you do services on account too, right? So you can earn money both via cash and billing clients. So if you kind of like think about it like that, where you're like, some of our revenue's in cash and some of it's in accounts receivable. So, but that service revenue or fees earned is always your full revenue. Yeah. And then expenses, it's always just revenue minus expenses. But yeah, it is tricky because you do think cash. Well, cash, I earn cash. But we could get cash from like selling equipment or, selling common stock.
That's service, that's not revenue. It's just,
Yeah. But right now it is. It's a hard, it's one of the harder things to keep in mind. Trust me, when I ask my financial class half the time, they're like, oh. And they've, been doing it for a while. So, any questions on what we covered today? Okay. So,